Basically, going into the pandemic, there was a pie chart where office was worth 3 trillion, and I'm just going to make something up. Resi was worth 6, just because there's more of them. What has happened is the pie chart shifted. So office is smaller, resi is bigger. That is so simple, but yet so genius. Alrighty, folks, I don't know if you are following Resi Club or not. If you're not getting the free stuff, I really don't know what you're doing. If you're not getting the pro membership, that's where the action is. But I want to talk about Jerome Powell punting on home prices. I want to talk about billionaire Barry highlighting a $1.2 trillion real estate pain. And most importantly, I want to talk about Lance Lambert's creation of a 20-year spreadsheet on housing that is just horrible. Horrible for Crash Bros. Lance, it's been a fun week. What's going on?
Yeah, a lot going on. Housing. This week was Fed week. Rates stayed still, not too surprising. Powell had a bit of a hawkish tone. And, I think what's going on is probably the fact that they got uneasy in October and November. The 10-year Treasury yield got to 5%, mortgage rates went to 8%. And I think if you hover around there long enough, that's pretty restrictive and probably more than they'd like to be given how much inflation's come down. But I think where the bond market and everything has gotten to now, with the 10-year kind of floating just a little under 4, I think they feel a little more comfortable. And they're kind of like, let's hold a little steady. And so he had a little bit of a hawkish tone. And my guess is I think he just wants the Treasury market to stay around here for a little bit longer. I think they had been a little more squeamish if we were still higher. And maybe if things had kind of already started to come down more, they might have been even a little more hawkish.
No, I agree with all that.
And during the conversation in the presser, Powell got asked by Nancy Marshall with Marketplace, and I'll read what she asked him. How closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected. Well, Nancy, housing prices nationally aren't going down. They're actually rising.
They're going up.
They are rising, yeah. And depending on what you look at, they're up 5 to 6% year over year, and above the peak of 2022, 1%, 2%, something like that. But still, the peak was when mortgage rates were at 3%, and now, we've been in an environment where they've been hovering around 7%. So great deal of resiliency for home prices, given that affordability just got cooked. And standing at the podium, Powell responded saying that the Fed is not targeting home prices and insinuated there hasn't been enough housing built, and that's the real culprit. And he said, and I'll read this as a direct quote, our statutory goals are maximum employment and price stability. And that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but those are not the things we are targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, this is when Zuber says the Fed broke housing. And then Powell says, when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it is very rate sensitive. On top of that, we have longer run problems with the availability of housing. We have built up a set of cities and people are moving further and further out, so there hasn't been enough housing built. And those are not things we have any tools to address. So here's how I summarize essentially what they're saying. And let me see if I can grab a paragraph that I wrote, and this is going to go in my Fast Company article today. Big picture, the Fed has a dual mandate, both unemployment and inflation and low, not housing affordability. And that is key, because think about it. When the Fed tries to keep inflation low, or they try to keep unemployment low, what they do is actually mess with housing affordability. When they jack rates up, they deteriorate housing affordability, which they're then trying to rein in inflation. And when they improve affordability by reducing rates, They're trying to help and bolster and stimulate the economy. So housing affordability is not the mandate. It's actually a part of the tool.
Correct.
And I think another thing that he's suggesting there is even if their goal was to drive home prices lower, based on what he said on Wednesday, it sounds like some at the Fed believe that just underbuilding and the lack of supply makes it harder for their toolkit to even do that.
Yeah.
And so that's where we were this week. The Fed admits they're not trying to drive prices lower, and they kind of insinuated even if they were, they might not be able to do it. I think
Yeah.
that's what I think that's big picture what he was saying.
Yeah, I think that's very well said. And again, I think the Fed broke housing, broke it for years to come. They can impact transactions, aka affordability, but not price. And that is what I've stood on for more than a year and a half now, ever since a lot of crash bros talked about Powell's coming after housing. So we were right, they were wrong. But now let's move on to Billionaire Barry. Just in the last 24 hours, Billionaire Barry is painting a picture where the real estate market is on the cusp of a $1.2 trillion write-off loss. He's talking about the commercial market or office being worth 3 trillion, now worth 1.8. Lance, I know you don't focus a lot on office, but that $1.2 trillion is sitting on somebody's balance sheet. And,
You know where
there's
it's
going to
at?
be some pain.
I can tell you exactly where that it went. It's still here. It's in the residential market. We had a secular shift in housing with the shift to remote, and that value just went into resi. It's still here. Real estate on net
It
did
just,
not lose it. It just went into resi. And then resi, of course, added on top of that too. But you know, that didn't disappear from real estate. It just went into resi.
I think
But at
that
the end
is,
of the day,
I have never heard a better explanation than what you just gave us. Basically, going into the pandemic, there was a pie chart where office was worth 3 trillion, and I'm just going to make something up. Resi was worth 6, just because there's more of them. What has happened is the pie chart shifted. So office is smaller, resi is bigger. That is so simple, but yet so genius.
yeah, it's just where it went. People's times are spent more in residential structures than they are in office structures. The value of resi increased because people wanted more space. You know, people who had roommates, and maybe in like New York City, they saw their roommate, I don't know, 2 hours a day, and then it went to 10, and they just got sick of each other and they couldn't do it. And so what you saw is you saw a net increase in housing demand, a secular shift that increased housing demand, even in the markets like San Francisco that lost population. So even in these places during the pandemic where people were pouring out, home prices were still moving up because net demand for space increased. And so I think we can't ignore the secular shift that we just went through. And, you know, you'll hear people saying that, you know, the return to the office is huge and all this. But if you look at the numbers, it really fizzled out summer of 2022. And we are still, occupancy is so far down. And just a lot of offices are not going back to the 9 to 5 traditional. It's not happening. And, you know, I think the big question would have been if a recession had happened, which way does it break? Does it break in terms of, okay, recession's here, we need to cut cost, we're not really using this office space, let's get out of more of these leases? Or is it, you know, more of these executives are like, you know what, I've wanted people in, this labor market's been so tight, I haven't had the power to pull them into the office. Now I finally have the economic power to put butts in seats. So that would have been the thing I was most interested in following. But you know, right now, labor market through this rate hiking cycle has stayed tight. You know, while it's definitely not the raging economy it was in 2021, where, you know, everybody's getting crazy raises and, you know, a lot of job hopping, it's definitely softened, but it's not been to a point where, you know, these employers have a lot of economic power. Like, let's say this scenario had played out in GFC employers had all the power. If they wanted to put people in seats, they could have done it very easily. Very, very different labor market. So in terms of like what's going on and the ins and outs of commercial at the moment, don't have a great pulse there. but the secular change that we've seen it's definitely proving sticky.
No, I couldn't agree more. And I think that's one of the reasons single family or residential, resi, will continue to do well, because the house is more than just that, where you sleep and eat dinner, right? It's where you work. It's all those things. So very, very cool. Well, now let's talk about the 20-year spreadsheet that you've put together for many major markets. Again, it is a horrible spreadsheet for the Crash Bros, but I think we need to talk about it. I think we need to look at it. So share away.
Yeah, let me pull it up. So this is just copied and pasted right out of my Lance Lambert uh, house price tracker. And my Lance Lambert house price tracker is one of the features that my premium audience Resi Club Pro gets access to the spreadsheets. They update every month. And I literally just pasted this in, this data. And what it shows is it shows for the 800 largest markets in the country, the 20-year change, 15-year change, 10-year change, 9-year change, 8-year change, 7-year, 6-year, on to 1 year.
Wow.
And what it shows is, really, I think it's a vindication of the 5-year rule in real estate, which is, if you're going to buy a property and it's your primary residence in particular, plan to own it for 5 years, because between the capital gains taxes that you could potentially incur if you sell before 2 years, and then the closing cost, and then buying another home with closing cost, and then just the simple fact that, while national home price crashes are very uncommon, Great Depression, GFC, regional home price declines happen. They do.
Oh,
They
totally agree.
all the
Yes.
time. Oil bust, little, things like that. You can have little things that are implemented on a local level that decline values in a certain area relative to another. But on a 5-year basis, usually you rebound. And I think this spreadsheet speaks to that, because inside of the spreadsheet, while you can't see it, is the once in an 80-year housing crash that we saw with the housing bust. And it's the one period of time where that 5-year rule was really broken. Because if you bought in 06, 07, a lot of people 5 years later, that was actually the bottom.
Correct. Correct.
So it's the one period that really tested the rule. But even with that, it's embedded in here, but it's all recovered. So you can't even see the declines anymore because it's recouped. Otherwise, this 15-year column, which is 08 to now, would be
Right.
red still. Look at Miami. And Miami was a place that, went really high for the bubble. And Miami home prices are actually 141% above the bubble. So that's how I would think of the 15-year column. The
Wow.
15-year column is essentially above the 08 bubble, since it's this spreadsheet is December 2008 to December 2023. So just a couple months into the crash. But yeah, essentially,
Yeah. Can you
most
do,
markets are
this is the
100%
800 largest market. So I believe my favorite market is on there somewhere. Fresno, California. Any chance you could just do a quick search? But if you
since
can't,
this
it's okay.
isn't the embed, let me
That's okay.
see if I could do it on my phone.
No, it's fine. Don't worry about it. I'll look at it later. I have access to this. I'll look at it. I was just curious. It was easier. But one of the things that I've often said is inflation is a feature, not a bug. And, this is just another example, right? The other thing I tell people is getting wealthy is easy, right? Discretionary income, invest, and then hold for 10 years. If you look at the 10-year column here, those are some really impressive numbers. And the other thing that's wild is that is not adjusted for down payment. What do I mean by that? That's just price for price, right? You're looking at 10-year 97.4% for the US. You and I both know that very few people buy homes for cash. Let's just assume 10 years ago you put 10% down. You're up 1,000% on your down payment.
So I do have Fresno here for you.
Oh, wow.
Put it up on my phone. And you can type in your market. It's just this one isn't working because I'm in the dashboard where I build it.
Right. Yep.
But if you have the link, you could type in your market. Fresno is up on a 20-year basis, 112%. On a 15-year basis, it's 104% above the bubble peak. 10-year is 112, and that's because,
Yeah,
it
it
had
bottomed
fallen.
in. Yeah,
Yeah.
yeah.
9 years, 97%, 8 years, 82%, 7 years, 70%, 6 years, 56%, 5 years, 46%, 4 years, 40%, 3 years, 27%, 2 years. So this is December 2021 to December 2023, plus 8%. And it's actually up 3% year over year, December 2022 to December 2023.
What I found interesting in that is I was comparing those numbers with the United States average, and we're really close. Certainly once we start getting to the 10-year mark, kind of the historical average. So that's pretty cool. Okay, thank you for
Yeah.
that.
And another thing, so this is in the spreadsheet. And if you wanted the raw data by month, you could pull that in. And one thing I'm going to add this weekend is I'm going to do the full year forecast for the 400 largest markets in there from Zillow. And then I'm going to do the forecast for Moody's Analytics. So people have a side-by-side 12-month forecast from there.
Wow,
Um,
very
and
cool.
the Zillow model has been a little more optimistic. And the
Mhm.
Moody's model, if you want like the most bearish outlook, you look at the Moody's model, it's been the
Correct.
most bearish relative to the ones I track closely. But now Zandy has kind of capitulated and they think it'll just be a 0.4% decline this year. So essentially they're calling flat and Zillow's calling like 3.5% for the year. But you can go market by market and take a look.
Yeah, the other thing, so thank you for this, folks. You got to get Resi Club. You certainly got to get the free version. If you haven't got that already, I don't know what you're doing. ResiClubAnalytics.com. But the pro version gives you a level of depth and data that you're not going to get anywhere else. Certainly not for your market, your buy box. So I have it. You should go get it. Check that out. But here's a little bit of inside baseball I just had with the CEO of a lender. Conway Home Loans, you'll see them in Vegas. They just let me know that they hired 3 processors this week. They have not had a hire in over 2 years.
Yeah.
So I know you've been talking to real estate agents asking what's going on, but given that 50% of the mortgage brokers are no longer brokers, or whatever that's called, it looks like we may see the mortgage industry start adding headcount. Again, it's only one example, but you might want to poke around. It's see
Yeah.
if
Yeah.
others are hiring.
Well, we have seen a move up a bit, some refis too.
Mhm.
But I think what we have essentially seen is, I think transactions and just housing transactions and refis and everything is probably just smacked into the lowest point it could go.
Oh, I agree. We bought. That is now bottom. We build
Yeah.
from here. Might build
So,
slowly, but we build.
so I think what I think we smacked into it so hard at the end of last year that there's
Yeah,
a bit of just a bounce up off of it.
I agree.
And you also have some of the people who got in at 8% and are like, get me out of this. I want to
Yeah,
go.
I'm done. I'm out.
And they want to go ahead and see if they could refi, which I believe they could do.
Yeah,
Correct?
it's
Yes.
if they have FHA or VA loans, it's
Yes.
actually really quick. It's called a streamline, and no appraisal, no credit check, nothing. It's a streamlined process. There's a little check and balance to make sure you're not being taken advantage of. So yeah, if you have an 8% FHA loan, go get out of it. There's a way to do it.
And that's what I'm getting to. So think of the ball has been dropped, and as it got closer to the floor, it slowed down. So the decline in activity last year was kind of gradual. Then we got 8% mortgage rates, and it kind of went down further. But now we've smacked into that bottom. And so some of the smack is just the seasonality shift. Some of this is the fact that, you had some of the refi activities and stuff like that just has to happen because so many people got rates at a point percentage higher than today.
Yeah.
But the question is, what happens really going forward? And I think to get a meaningful recovery in activity, you have to have listings come into the market.
Listings.
The activity from buyers coming into the market can't move up transactions. It did at the beginning of last year, because at the beginning of 2023, people were so scared, so many on the sidelines. And once demand troughed, they came in and absorption tightened up. But this year, you don't have that now because we haven't been destabilized. There's already buyers and homes are selling when they come on. Inventory is not skyrocketing. And
Right.
so to get a move up in terms of activity, the resale side, you really have to have, new listings. And there, it's not going to be, it's not going to be fast.
No.
You do have some people who are like, I've had multiple kids, I really got to move, whatever mortgage rate, okay, 6.5, I buy it down to 6, I'm in, I got to go. But
Gotta
you
go.
really
Yeah.
have so much of that.
Yeah.
You still have a lot of people with the 2 and 3% mortgage rates and 4, that net effective that we talk about all the time. All the mortgages taken together, it's like 3.6 to 3.8.
Yep.
And just a lot of those people would take a huge affordability hit to do it. So to really get new listings up in a meaningful way and get resale transactions up in a meaningful way, you probably need a much bigger pull down in mortgage rates.
I couldn't agree more. This has been a lot of fun. I don't know if your son's nearby, but maybe the audience wants to see him. I don't know if he's close.
Yeah, you want to come say hi? Come say hi. Leo's a lot bigger than last time. Come up here. Come on. He's all shaggy.
That's all right. Hi.
Oh,
Hi, Leo. How are you? Oh,
You
hi.
say hi to the audience?
Hello, audience.
You say anything? No, you don't talk? Okay.
Too shy. Well, Lance, you're amazing. You want to give a tease for articles that might be coming out next week, and we'll call it a show.
Yeah, so I have an inventory update coming out today. We just got the realtor.com numbers. Inventory declined month over month, like
Ooh.
8,000 listings. So down last year, it was down 64,000. So not as big of a drop off in listings, but it did drop. We got the pull down and the seasonal move down in inventory. So I'll have that and I'll break it down on a regional level. I do have a story about a new startup that's kind of like name your price. Like they're saying, hey, there's probably some inventory out there that could sell, but they would only do it at certain dollar amounts. So they're trying to collect
Oh,
to be like, hey,
that's
as a whole
interesting.
matter, I would sell at X dollars. Because at the end of the day,
There's always a number. There's always a number.
yes, while there's the active listings, people actually on the market trying to sell, technically every home could be bought, other than maybe
Correct.
like Buffett's.
Yeah.
Maybe nobody could name his number, but
Nobody.
most people's we would move at a certain dollar. So
Yeah,
she's
that's
collecting that
probably
data,
true.
and I thought that was an interesting
Oh, that'll
startup.
be fun. Ah, very cool. Well, Lance, you're amazing. Have a great week. I can't wait to catch up next week.
Okay, chat soon.
Thanks.